Okay, y'all, so now let's get to defining high probability trades. A high probability trade versus what a low probability trade is and what a random trade is, right? A high probability trade is defined as trades with a high probability of rendering desired results. So what our goal is to pretty much take only trades that we can almost guarantee to win. That's just straight to the point, straightforward. We want to only take trades that will guarantee us wins. Now, nothing in life is 100% guaranteed, but there are things that have a high probability of being of taking place. So what we want to do is we want to have the confluence necessary, we want to have the setups necessary, we want to have the formula needed in order for us to take specific trades that will allow us to have a high probability of winning. So within this context, aside from the Blue Waves course, which goes deeply into the confluence factor of everything, aside from the Blue Waves course, this is pretty much to be layered on top of that and to define how to use the confluence and what needs to be focused on in order for you to get the high probability trades, right? So within this context, we will explore how allowing the market to show its hands prior to execution can equate to high probability trades. So what I mean by this is we're not just going to go in there willy-nilly trading. We want the market to show its hands. If you ever played poker, if you ever played blackjack, if you ever played any game, Uno, if you're contested, if the individual that you're going against shows their hand, it makes it easy for you to know what's going to happen next, right? So the market also does this. The chart does this. It shows its hands. When a move is getting ready to happen, the market shows its hands. So we only want to take trades where the market shows its hands and shows that it's ready to pretty much distribute and expand. We don't want to take trades that are primarily based on guessing, because once you're guessing, you're gambling. Once you're guessing, you're gambling. You don't want to guess. Once you get in a position where you don't know what's going on and you don't know what's happening, don't click that button to execute a trade, because now you're guessing, you're gambling. And when you're gambling, you're getting low probability trades, because you haven't refined it to a point where everything is zeroed in order to give you the high probability trades, right? So given the proper price movements executing within specific times or time frames, bring about trades with higher probabilities of winning and lower risk. Now, what this means is, I'll get into the formula soon, but what this means is price is going to show you its hands, and when these hands are shown in specific times, which I call hot zones, this will bring about trades with higher probabilities of winning and lower risk of losing, right? So this is going straight to the point, right? So this course is going to go straight to the point. I'm not going to drag on too long. It's going to be straight to the point so you can understand what I mean. All you need really is this course. Because this is the refinement of everything else, right? So given the proper price movements, executing within specific times and time frames, bring about trades with higher probabilities of winning and lower risk. So although these probabilities may be high, risk management should still be followed. No matter what, no matter how you trade, your risk management needs to be on point. So even if you get into a high probability trade, you can still be stopped out whether it's news, whether it's anything that may be going on, whether it's just price wicking, you can still be stopped out, and you don't want to be stopped out with poor risk management, right? So let's move forward, and we're just gonna get this going. The high probability formula. Write this down, because this is gonna be your best friend. And what I mean by that is, once you know the formula, once you understand the formula, you're not going to want to trade anything outside of it, because this will render the most results for you, as it's pretty much everything simplified in a way where you can take advantage of the charts to its fullest, right? And this is every chart. This is Forex, futures, stocks, crypto. It's all the same thing. All financial markets have the same candlestick charts, you can use the same thing, the same formula, in order for you to get high probability trades. This is why this is very, very important. And it's this right here can make you a millionaire if you just compound what's being taught, right? So HT times HP multiplied by M plus MSS, that equals HPTR. So high probability time multiplied by high probability price. When you get those two, and those two come together, so within that time frame, high probability price is what this is. So within a high probability time, a hot zone, when you get this, you'll receive this. So high probability time is pretty much M plus MSS. So manipulation plus market structure shift, that equals a high probability trade. So like I just said, H time, high probability time, times high probability price, which is this, manipulation plus market structure shift, equals high probability trade. That's all you need to know. All you need to know to have the best setups, the best entries, and high probability trades, right? This is mainly in the entry. Exits, you can, based on, the Blue Waves course, your exits could be your previous high, can be order blocks, can be gaps, can be liquidity zones. Those are exits. For entries, for the actual trade, for the most important part of the trade, you need this formula to show. If you trade outside of this, there's a high probability of you losing that trade. So this is the key, the legend, as they call it. What HT mean, what HP mean, what M mean, what MSS mean, right? So in context, we want to see examples, right? We want to see examples in context. And this is all what I've been teaching and what I've been saying over and over and over, right? But in context, we want to see examples. And I'll pull up a chart. I'll pull up a chart for you. Okay, so looking at this chart, this is avalanche. This is what I mean by, no matter what chart you're looking at, this is always going to be the same thing, right? And high probability trades are in every single chart. So I'm going to show you what it looked like, and then I'm going to break down each part of this further along in the course, so you can understand why. You can understand what's going on. You can understand why. You can understand how you could take advantage of these moves, right? So when you look at this, when price actually started moving, before it started moving, this tail formulated, right? So this tail being formulated. So if we look at what's going on, right, this is the context of this is what I'll call like a weekly trade. But this is crypto, so this is totally different. This this will be like a weekly trade to me, right? So within that context, what you see is price shot down. So you have that high probability time. Crypto is always in a volatile time. So when it comes to Forex, there's specific time zones and time frames for you to trade. When it comes to crypto, it can happen at any time. So that's the difference between the two. So a high probability time. Let me pull this up on. I need a notepad. I need a notepad. Let me get a new notepad real quick. So the high probability time multiplied by the high probability price. High probability price is defined as manipulation plus market structure shift. So this right here is a high probability price. It's a manipulation at the bottom, and this is a market structure shift because it failed to break the previous low. And that's what a market structure shift means. In terms of market structure, you guys should already know based on the other courses, which I advise that you go watch over if you don't know what a market structure shift is. But where is it? When the trend is going, it's going. This is a trend. This is a bearish trend. When it's going, it's going. I don't know why I always do this. Let me do that. Right, so for bear trends, you'll always get lower highs and lower lows. You'll always get this, a lower high, lower low. In the transition point of a bear trend, meaning when it's being shifted from a bear trend to a bull trend, this is going to be broken. The high is going to be broken. The high is going to be set to be broken, and the last high is going to be set to be broken, and the last low down here is going to be failed to be broken, right? So that last low is going to be respected. So as this is coming down as a bear trend, right? As that's coming down as a bear trend, this zone right here where it's actually retracing and it's coming back to test these highs and these and fail to break the low, those zones right there are the zones that you need to be watching out for. This is what you need to be looking out for. This is where high probability trades take place. So let me preach a little bit. Seeing how the last high and the last low, when price went up to test this high, it failed to break, right? But when it came back down to test the previous low that it made, it failed to breach. Now, usually when this happened, a lot of people would, head and shoulders, but they don't know what a head and shoulders is and what it means. But the thing is, you can catch this before the shoulder is even formed. You can catch that. How? Once an explosive move happened and you zone down to a lower time frame, you'll start seeing the same exact formation on the lower time frame. So now, and this is pretty much like I said, it's the Blue Waves course. If you go back to the Blue Waves course, you'll see that. This is the second volume. So, once this happened and price fails to break this high, if it breached that high into the actual zone and it fails to break, usually what will take place with price is this. If price is going to continue going down, it'll respect around this zone and continue pushing. Around the previous low zone, it'll respect. It won't trade back into the zone that it just left. So usually it'll respect that. These are order blocks, right? So it respects these order blocks. So once it fails to like respect this and it goes too deep in the zone that it just left, that'll give you a telltale sign that price is going to reverse. And most likely you'll see an order block down here, a gap, and you could draw your Fibonacci, however you want to play it, and you could catch this. You catch it at a low point, or if you're an aggressive trader, you could catch it down here with a doji and engulfing. So if this runs down and there's a doji and engulfing, which I go over in the Blue Waves course, and there's a doji and engulfing, that's going to give you a sign that is going to run up, right? So this is all you're looking for. All you're looking for is this. Mainly manipulation. So once manipulation happened, and being conservative, I'm talking in terms of being conservative. Once manipulation happened and there's a market structure shift within the hot zone, that's when you take that trade. If you don't see this, it's not a trade for you. Don't touch the chart. I'm giving you practical things to go by. I'm giving you practical things to go by. If this is not present on the charts, do not trade. Right now, I'm giving you a formula. I'm giving you something practical to touch upon that you can follow day in and day out. You can follow day in and day out. You can compound. Nothing else should be followed. In order to limit the confusion, nothing else should be followed. If you only follow this and you don't need, to understand too much about the order blocks, too much about the liquidity, too much about harmonics, you wouldn't need that entirely if you just follow this. You could just follow this and run it to the previous high. But if you understand how market structure work, how the institutions work, and you're an advanced trader, like a lot of us are in the trading group, then having the knowledge with the actual liquidity, order blocks, even with harmonics, having the knowledge with that and understanding this is how you'll enter your charts, then that'll make you a master trader. But for beginners, for those individuals who's having a hard time, who need clarity, only trade this. Only trade when you see this. Let's go back to the chart so I can show you what I mean. Only trade when you see this is a bear move. Doji engulfing, it started running up. If you go down to a lower time frame, you see the market structure shift. It fell to break the low. Only trade when you see this. If you miss that, it's still, because the market is fractal. Everything is fractal with this. See how this come down on the grand scheme of things. So if you miss the lower time frame move, if you miss this, and you didn't get in here, you could wait for it to breach the high on a conservative move. Once it breached the high, that's pretty much confirmation that it's going to start running up. And then you just have to wait for the retracement. Once the retracement happens, you'll see the same thing happen here. A high probability setup. And this is right here. Price does not go any direction until there's a high probability setup. Every single retracement will have a high probability setup. So this is like the stop sign for price. It's the stop sign for it to hit the U-turn. So if you take a look what I'm saying, every single turning point, you see a high probability setup. And this is why I stress this so much. That's a turning point. What do you see? A previous high, broken, fell to, you see, previous high. That high was broken, price manipulation. High broken, when it come back into the zone, that's price manipulation. So that's manipulation, and when it retraced and failed to break that high, what do you have? That's a market structure shift. And what happened? The previous low is now broken. That's the shift in structure. Because now, as price is going up, it shouldn't have broken any previous lows. It broke one here, continue running up for the extension, and it came down, and then this low has been broken, and now it's coming down. Same thing happened here. Let me plug up the chart, the laptop real quick. So same thing happened here. Equal lows created, manipulation, that wick all the way down. It came up, failed to break this low right here. Market structure shift. Previous high broken. Like I said, you don't have to catch it at the tail. You don't have to catch it down here. Previous high broken. This is what I call the big fish manifesto, because it took time for me to just refine it to being as simple as this, right? And this is what I'm giving to y'all as something, the only thing that you need to follow if you want winning trades. This is high probability trading. So you see, high broken, the high was broken, it retraced. Once any high is broken, if it's retracing, if it's going a specific direction, once the zone is broken, you have to wait for the retracement for your entry. So this is the retracement, and look how it shot up. Same thing up here. We can go forever with this. I just want to show you guys examples before I get too deep into the course. So previous high right there. Look how this shot up like this. Manipulation is always going to look something like this, where it's like an explosion shot. It shot up and it shot right back down. But look at what happened, right? The previous high broken, low created, high failed. This failed to break the previous high. When that failed to break the previous high, entry. Run down to gap, run down to order block. And if you need understanding on that, Blue Waves course. Run down to gap, run down to order block. Right? But understand what you're seeing, manipulation, market structure shift within the hot zone. And you can just run that anywhere, like manipulation, failed to break. Even this minor move. But this is a more higher time frame move right here. Manipulation. This is manipulation, right? Market structure shift. And it's projected to go up, right? So this is what it's just an example of, you know, what this is. So now this is crypto. Let me pull up a Forex chart real quick so I can show you based on hot zones. Okay, so this is AJ London session example of a hot zone. See how this shot down at 1:15. You're sleeping. 1:55. 2 a.m. 2:30 is where you start projecting London move. Based on what I'm gonna show you guys in the future part of the course. So we can mark out London. We can mark out when you would pretty much get in front of the charts to look at the previous lows and previous highs. Then we can mark out when you'll start trading. So this will be, I'll say when you start projecting. This, we could say when you start trading. London hot zone is 3 a.m. to 5 a.m. which you'll see as the course go on. So look at what took place, right? So this was at 2 o'clock. You wake up, you start looking at the charts. The charts hasn't shown this part yet. You start looking at the charts. But you see the high and you see the low of what took place so far. This will be the high of what took place so far. And this will be the low of what took place so far, right? So you're just looking for a breach in the market structure shift. That's it. So as this came down, this created a minor high right there. And this price coming down, this low being created, and price coming down and running back up into that low is pretty much making this manipulation, and this a market structure shift for the buy. And all you need to do is wait for that within that time zone and take it. This is the shift. This is the manipulation. This is a market structure shift within the hot zone. This is a London hot zone. Let's see if we can find more examples. One more example before I continue with the course. Right here, right? So take a look at this. And this is another London example, a London hot zone example, right? Let's say if you start analyzing here, you start trading here, you only need like 30 minutes to analyze what's going on because you just need to see the previous high. So within this zone, there gotta be some kind of manipulation. But if you take a look where you analyze, you'll see this being your high. This being the previous low down here. But look at, once it hit 3 o'clock, these highs right here, after I think it what, 3:35, this is considered a hot zone. From 3 to 5, hot zone. It went up, reached the previous highs, failed to break this high. So now what we have is a what? Manipulation. Market structure shift. And that is it. So if you just follow this formula, you will have high probability trades. So if you only follow this formula only by itself, gold. But you have to determine what time frames you want to trade, what type of trade you want to what type of style of trading. Is it scalping? Is it swing trading? You have to determine what you want, what kind of trade you want to actually strategy you want to actually partake in, and you can only watch that one pair, honestly, every day, and just wait for that structure shift. And then if you miss it, you just miss it. You don't have to jump from pair to pair to pair to pair. And this happened on indices, and this happened on crypto, and this happened in stocks. And I'm gonna just continue showing you guys examples and running through all this stuff so you guys can get the clarity needed in order for you to understand what this means. This is the all in all. This is how I've been trading US 30 scalping when I was on my hot streak that one year just killing US 30. This is exactly what I was just doing. I was just waiting for manipulation. It's as simple as that. But like they say, getting rich is boring because all you had to do is the same thing over and over and over and compound it. Getting rich is not exciting. Don't look for crazy exciting moves. Just look for the same thing over and over and over. Keep on compounding. As you making more money, add more risk. As you make more money, add more risk, and you'll be good. So that's all I gotta say for this actual module, the high probability trades module. I just showed you the formula and I ran through the actual move, and I'll show you exactly how it goes. And I'm gonna continue showing you examples and breaking down exactly why this takes place, so you understand and it's not just, willy-nilly. So until next time, big fish, let's go.